Welcome back to Bull Sessions here on 680 KFEQ. You can email your questions or comments to bull@willcross.net. Once again, here's Randy Baker and agronomist Brad Law.
Okay, now we're back. We got to have commercials.
Gotta have commercials.
We got to have them, Bradley. And they're short, they're brief, but here's what we're back to do. Bean of the week. Before we go into bringing our guest on and Lady in Ag, Focus on the Farmer.
You know where you can find out about the Bean of the Week?
Tell me where.
You can go on our Facebook page.
Yes.
That's that facebook.com/Willcross Bull Sessions.
Okay.
And you can see that on...
you been drinking?
Pepsi.
Okay.
It had cherry in it. Gotta get ready for your party on Wednesday.
Yeah.
But I released the Bean of the Week then, and every week I've released a new bean. Then we're doing a Throwback Thursday on there.
Mm-hmm.
Even putting links to our YouTube videos on there. So if you want to catch something that we may have said or watch me stutter over something or like, oh, how many times did he make fun of Randy in that segment? You can go back and watch it again.
Much too much.
So our Bean of the Week this week is 7416.
Big bean.
Well, big bean, but not big seeded.
No.
It's running around 3,100 seeds is what we're looking at maybe this year.
We love that.
So it's a 4-1 maturity. It's light tawny.
You just can't ever get that, can
I can't.
Like glyphosate and glyphosate. You don't get it.
I got redneck grammar. If you're all right with redneck grammar, like our Facebook page,
we're
how about
okay
that?
with it.
It's about 40 inches tall. Personally, I feel that this bean is best in narrower rows, like 15s, 10s, 7.5s. I don't think it's ideally fit in 30-inch rows, but it's done all right.
It's just because it's tall and skinny.
It's taller, and what it is, we want those beans to shade our 30-inch rows. And that one, it takes longer for it to shade the rows.
Great yielder, but it could help with some weed control or getting that canopy quicker, right?
We want that faster canopy. So good 4-1 maturity, glide-tolerant soybean. Going to get that seed cost down under $30 an acre for naked seed.
We love it.
You know, so it's a good bean to maybe stretch your maturity, or if you're down in our southern listing area, it may be just right in your maturity.
It would be, yeah.
So got that for
east,
you.
Guys, east and west.
East and west. All right.
Had that.
Well, I think somebody southeast of us is on the line.
Let's get him on here.
Hey, Ray, can you hear us?
Yes, I can.
All right.
Hi, Ray.
We have Ray Massey from the University of Missouri.
All right, Ray. We're glad to have you on the show today.
Thank you.
And Ray is a numbers guy, and he understands a little bit about crop insurance and does a lot of scenarios and just lots of cool slides and stuff that a lot of farmers won't take the time to look at, but they really should. So, Ray, how long have you been with the university?
I've been with them now for almost 22 years.
Well, that's a day or two.
Yes, a day or two it is.
It is a.
Oh.
What
exactly are you do? What exactly, I farmerized what you do for the university, but what is your official job at the university?
Well, my official job is I'm 100% extension, and so I talk with farmers and business persons. I tend to focus on risk management, so that goes anything from crop insurance to policy changes and weather information and how that helps people. So I say I look at the interaction between production agriculture and the environment.
Oh, wow.
Cool.
Right up our alley here. Ray, you said crop insurance. I know that's this time of year we got to get going on that. Is there any changes or anything we need to know about you could tell our listeners?
Well, yeah, there's always a few things that are changing.
Sure.
The Risk Management Agency of the USDA really is encouraging whole farm revenue protection this year.
Mm-hmm. And what is that exactly?
The whole farm revenue protection is where you are going to insure the entire revenue. So normally when you think of crop insurance, you're looking at either corn or soybeans or wheat or something of that nature.
Right.
In whole farm, you'd group it all together, and you're looking at the revenue from the farm, and you're really comparing, it's not exactly, but you're kind of comparing your Schedule F from one year to the Schedule F of the next year.
Mm-hmm.
And so you're insuring what your revenue is going to be. That was a simplification, of course.
Mm-hmm.
Mm-hmm. It doesn't matter if that's corn or soybeans, there can be all grouped together, right?
They're all grouped together. In fact, livestock, you stick livestock in there, tree,
Really?
or horticulture, things of that nature, put it all in there together.
That's good. Okay.
In fact, you get to put some of your sales. So if you happen to be a salesman of custom rates or some other product, that'd be in there too. So it really offers what a lot of people want of, hey, I need to have a certain amount of income to live every year, so I want to insure my whole farm revenue.
Well, and that, you know.
But I was going to say that a lot of folks at the same time resist it because they say, hey, I had one field that, or, you know, one crop that didn't do well, and I'm not going to get anything because the other one did do well. And so they go, I really do rather insure a whole crop or a field or something of that nature.
Mm-hmm.
Well, like when we talk about insuring one field versus everything, they talk about enterprise units and basic units. We know kind of what they are, but can you kind of make a simpler definition of them? Like what is the difference between having an enterprise policy and just a basic policy?
Well, from just a practice standpoint, an enterprise policy is going to combine all the acreage of a certain crop by county into one insurable unit. So let's say you're a farmer that actually farms over the county line. So you farm in two different counties. You'd have all of your corn from one county in an enterprise unit and all of your corn from another county in a different enterprise unit. But you could have 10 fields in one county and 2 fields in the next county, but those 10 fields are one enterprise and the 2 fields are one enterprise. So it's just all your corn is together. Whereas if you take a basic unit, you actually can have a little bit more discretion because you'd say, well, this one here is on my land, and so that corn is corn grown on my land versus corn grown on a crop share land or even corn grown on a cash lease land. So you can break it down much more fine with the basic unit. The negative of that is you're going to be paying a little bit higher premium.
Yep.
The positive is that you're going to actually be able to have one field that goes bad, and it happens to be just the only tenant cash lease that you do, but it's broken off as a basic unit. And so you can receive an indemnity on one field.
And then, you know, because like if I had 4 fields and they were all 100 acres and 3 of them did awesome, and then one of them, it got flooded or it hailed out on it. Well, those others did good enough where they covered up where, it was just an average year instead of 3 awesome years and a crop failure. Mm-hmm. It made it where that one would have paid also. But
yeah, so let's just take your example there and say that you insured 75% of your yield or your revenue. 3 of them did marvelously. One of them was really poorly. You're still going to get 75% probably if you're doing an enterprise unit. And so you're not going to get an indemnity on that one.
Mm-hmm.
You did a basic unit, and that one field happened to be separate because it was owned land and the other ones were rented land. That one poor field you're going to make an indemnity on because that's the unit that you insured.
Yep. You paid more for the premium, but it's, you got to balance that cost of the premium versus what's the probability of a payout, and it's just different ways for different people.
In fact, that's what I keep trying to communicate to people, is that insurance is a way to try and deal with a negative outcome, whether it's yield or revenue or something of that nature. And so really you need to define what is a negative outcome for you. And 3 fields doing great and 1 field doing poorly, for some farmers they're saying, hey, I'm still doing above average, I'm doing okay.
Right.
Whereas for another one, they'd say, I cannot afford not to have a good yield on every farm or on every field, and so I need to have a different type of insurance.
Well, and like even your lenders, they want to see that, if you're wanting to borrow money to put a crop in or something, and you can take a piece of paper to them and say, see, my total guarantee is this much money, they can say, okay, then I will loan you such and such percent of that based on everything else, because we can go in and put a tag, and if you've got a payout from crop insurance, they're going to pay it to us and you, so we're going to know we're going to get our money back.
That's right. Now, I would make one caution there, is if you're using revenue protection, which does guarantee you a revenue, it's using the futures price, and so the price that you may actually get at the farm may be a little bit different. So just recognizing that keeps you from having a misunderstanding later on. But you're exactly right. You can take it to them and say, I have a revenue protection of this many thousands of dollars.
And it's an option, And, we were talking about the price. We probably ought to wait till after our break to get into the price. But, the price discovery, sales closed, and we got corn set at $3.96 and soybeans at $10.19. So that's kind of that's positive from last year. And maybe Ray can explain more about the price discovery when we come back.
Yes, we've got to sneak away here for just a second, and we will come back with more of Ray, Lady in Ag, Focus on the Farmer All, when we come back to more of Bull Sessions on 680 KFEQ.